try not to kill myself on the way up. Right. David asked me to talk about institutional investors, and I thought I would talk about it in terms of what we as institutional investors look for, but also in terms of what other investors should look for in institutional investors. For a start, I thought I'd start with why institutional investors should bother. It's a very small asset class. They're inherently illiquid assets, untested in a downturn, and they're being originated by platforms that a lot of them have no skin in the game, little regard for the costs that they're running up. They're dependent on VCs to provide them with an unlimited amount of equity. They're learning to underwrite as they go along, some of them with no path to obvious profitability, and a lot of people will tell you that the opportunity will disappear as soon as rates rise. So I thought I'd take a look at each of these in turn. In terms of the asset class size, I think there is a lot of misunderstanding of this point when you're talking about the institutional market. If you look at pure peer-to-peer lending, it is a relatively small market. However, the institutional market for direct lending is huge, runs into the trillions of dollars globally. And it's something that's been around for a long time. So institutions are interested in this market not because it's a very small market, but because it's a very large market. The smaller SME end, which is where we're invested, has been emerging over the last few years, but it's within a much larger asset class. So don't think that it's an asset class which is coming from a very small base. I think the other thing that's important when you're looking at it is to not assume that this is something that will continue to have as a proportion a vast amount of individuals in the asset class. I think as it grows, the proportion of individuals will gradually decline, and the comparison that I would use would be if you look at what's happened in the Lloyd's insurance market since it started introducing corporate capital in the 1990s. It was a specialist finance market which produced consistently high returns for decades, very much like specialist lending to SMEs, and it was financed by individuals. Once corporate capital was introduced, those individuals were squeezed out of a lot of platforms completely, and it's now a relatively small part of the market as a whole. They're still there, but it's a relatively small part of the market as a whole. There is a challenge for a lot of the platforms that are out there, though, that at the moment, because they're originating a relatively small amount of loans, what the platforms need is they need institutions that are able to look across the valley. And by that, I mean that to look to a point when these platforms are going to originate hundreds of millions of dollars, not single-digit millions of dollars a month. And if you've got institutions that are prepared to, then they'll be able to lock in that capacity now to then allow them to put a large amount of money to work in the future. In terms of liquidity, I don't think there's any way of getting away from the fact that it is an inherently illiquid asset class. It is a buy and hold asset. There are some secondary markets, but in reality, there's not enough liquidity to really give you anything other than a notional liquidity. You can only really measure the liquidity of your portfolio by the duration that you have on it. And if you look at what happened in the US middle market loans, which is a $1 trillion market in itself, you never really had a secondary market until after the financial crisis. Our business, prior to getting involved with what we're doing now, was involved in US middle market lending through a third-party manager. And it was very interesting to actually see, as someone that has a background in equity management and so had been very experienced in secondary markets, the fact that no one in the US middle market loans really did secondary market until suddenly the market gapped down from par 101 to 65 and suddenly everyone had to learn how to operate a secondary market. One thing that we would need to see a proper secondary market is common standards in terms of the terms and conditions, in terms of definitions of things like non-performing loans and defaults and recoveries, which we don't have at the moment. I'm not sure whether there is truly an appetite to see common standards across the piece because certainly from the larger platforms perspective, it would be nice if perhaps they had a little bit less competition. And there is a degree to which it's turkeys voting for Christmas. But I think there's a possibility that we could get common standards eventually, but it's certainly not going to happen immediately. One thing I think is a major concern is that this is an asset class which hasn't been tested in a downturn. There are some shockingly naive remarks that come out of some CEOs of some platforms. I think that the pricing that you see on some platforms is remarkable on some loans and possibly incredible. Investors are right to be worried, and I think you have to look at why there is some of the pricing that you're getting. Possibly, if you're going to start preparing for an IPO and you need to build up your loan book, because that's what your investment bank tells you will maximize your valuation, might be a reason why you might price in an incredible way. We shall see. Certainly, I think one of the things that I would recommend everybody looks for when they're looking to invest through a platform is a significant amount of finance company experience at an operating board level. Not on the advisory board, not as a non-executive, not as an independent director, people that are actually running the business who've run finance businesses in the past. Because it's all very well saying we've got someone on the advisory board, they're not actually going to make a difference to the way that the business is run day to day. Can platforms be trusted? Interesting. I think there is an issue clearly in that platforms don't have skin in the game. There is always the argument that if they had a bad debt experience, then no one would come back, but actually they're not going to lose their own money directly. And it is an issue. I would say that a lot of platforms, their cost of acquisition is probably higher than their lifetime value of that customer. And that begs the question, what's the point? Underwriting teams and methodologies vary widely in the sector. If you're going to invest through a platform, understand how they're underwriting and challenge the way in which they underwrite. Many of these platforms have a relatively small balance sheet and certainly not something that will take them through to profitability, and many of them are not running to get to profitability within a reasonable time frame. I'd take a look at who's backing them and ask the question of, if they can't raise funding elsewhere, are the current backers going to be prepared to step in and fund the businesses through to profitability? I think 2015 will be a challenging year for many. We've certainly had one or two informal inquiries from one or two platforms that are concerned that perhaps things are not going to go the way that they thought they were going to go. And I think that there may be one or two casualties this year. Will rate rises kill the sector? It will certainly have a pronounced effect on the sector. People who say it won't affect the sector are, frankly, just lying to themselves. I think that it will start to differentiate between those businesses that are simply doing what the banks do, as I said here, banks light, which I think will struggle in an environment of rising rates. But those businesses that are actually doing something that the banks can't or won't do actually should be in a better position because there will be a large amount of business that they will be able to write because rates are going to rise because the economy is doing better. I think peer-to-peer will reduce as a proportion of the industry as a whole, as you see less enthusiasm from retail investors. And I think one thing that's worth remembering, and I can tell you as somebody that was 25 years a financials analyst and fund manager, there's no asset class in history that has ever had net inflow across the cycle. So there will be times when retail investors don't want to invest. And if a platform doesn't have a plan B for where it's going to get its lending capacity from, it's going to have to cut back the lending that it does. So why bother for institutional investors? I think there are significant risks out there, but there are rewards. If you're prepared to do your due diligence, then this is potentially a low volatility, uncorrelated asset class, and it should be attractive to institutional investors. The great news for us institutional investors is that there is tremendous opportunity to add value because there are some shocking errors that are being made by people out there, but equally there are some great opportunities. Some institutions, when you're looking to invest with them, are doing proper, rigorous DD. And I know because some of them have looked to put money through some of our platforms, and we've seen the amount of DD that they're looking to do. And that's great. However, I'd say some have great PowerPoint skills, and just think about it when you're looking at some of these funds, challenge them on what they're really doing, what experience they've got, and whether they really are going to add value. If you do your DD on the institution, there is great opportunity to buy into a really exciting asset class. If you don't, then don't blame me if you lose your shirt. Thank you.